Thank you for joining us. This is the Traders Exclusive Live Trader Showcase. I'm Sherry. Please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. So before we get started, I will share the quick disclaimer. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time, and past performance is not necessarily indicative of future results. Many thanks to our sponsors for the June Live Trader Showcase, Market Taker Mentoring, TechniTrader, and Money Mentor. Please go check them out at markettaker.com, technitrader.com, and moneymentor.com. Thank you again.
Okay, so as I said, what I'm going to talk about today is what we do. So we've been at this for a long time. So we started doing this in, 1996, and then really started doing it professionally in 1997. Sherry was kind enough to mention my bestie, my wife, Julie, who I've been trading with since the very beginning. We started doing this back in graduate school. And so we were finishing our PhDs and we were finishing MBAs and stuff. And, by the time we got done, much to the parents' horror, we never actually got a job because everything that we researched in school, rather than taking that data and going to work for, I was going to go do a McKinsey and Company gig. And then I was hoping, after 5 or 6 years or 10 years or whatever, I'd go off and teach at a university. And Julie was gonna, UN Women's Task Force, and we were gonna do all this noble stuff and all this great stuff. And then we just really got sucked into, this data that we were working with in grad school and everything that we were doing in school. And, by the time we got done, we said, we've spent so much time focused on the New York Stock Exchange, at the New York Stock Exchange, working with the data sets that we have. We really think we've got this down. And I had a major professor, a committee member of mine, who Peter Drucker, who probably, if you're older, if you're as old as we're old, right? So if you're as old as we are, then you remember Drucker. He was a big business guru, big, fantastic guy to have as a mentor. And he just said, run with it. If you've got a business that's profitable, go do this thing for a living. You can always go do something else. You can always work for someone else. So we did. So we took all that stuff that we learned while we were working on this, and we applied it, and the life has just been great ever since. So what we've done primarily, so before Connor came along, you can see Connor there sitting on the bull. Probably shouldn't be doing that, but he's sitting on the bull. We traveled, we live in Malibu, so we're out in Malibu, Pacific Palisades, California. That's a great place to live, but it's also a great place to travel from. So we take off and we have traveled the world for years and years and years. So every year we're gone probably, 5 or 6 months. We've got a really extensive speaking schedule. So that's how we worked college professor back into trader. We try to get every speaking gig that we can. We prefer the live stuff. Like, I like to meet people and be one-on-one with people. But, I'm starting to warm up to this webinar thing. It might just catch on. But when we get down to New York, right, I feel like we're home, even though home is 4,000 miles away. And, we still like that vibe. So we still like to get out there and visit the exchange every year, at least once, get down on the floor. It's not the way it used to be. It's not at all the way it used to be, right? It's very quiet now. It's more of a TV set almost sometimes than, and standing around in the Barclays booth talking about kitchen cabinets and football games. But the essence of it is still there. The stuff that we pulled data from, trading is about psychology. We're psychologists. It's, behavioral finance is really where our head's at. Organizational behavior is my PhD. And, we've furthered the research over the years. And what I want to show you today is how we take what we're doing and compartmentalize it enough so that you can actually make a living trading in just an hour a day. It's not a matter of sitting at your machine's doing something for you all day, every day, but your active time in the market can be pulled all the way back down to just an hour. we like to sit in front of them. We talk to our guys in the room every day. We just did a boot camp. Those guys know I enjoy working with, working with the market and going through, and when we're in front of the screens, I like to bracket up trades all day long and make sure that, I can find new opportunities and sort of stay frosty and get in front of things. But you don't have to. You can do this sort of on the road. You can do this and be portable. You can do this and not miss out on the rest of life. So this summer, hopefully we're back on Trader Nation. Keep an eye out for that. Julie and I do a television show. We film it on the set of Star Wars, believe it or not. So what a waste of studio space for a financial show. Hopefully we'll be back on if, the writer's strike kind of put the kibosh on this whole thing. And then there was the issue with the directors and everything. And by the time we got done, half the staffing changed. And, we're actually syndicated kind of a program, it's not a CNBC kind of a thing. So we'll see if the lovely people at Scripps decide that they want to run with it and get us back on the air. I do a bunch of publications as well. Sherry mentioned the books. We've got 2 books, Around the Horn, which is what everything I'm going to talk about today is based on. Around the Horn, a trader's guide to consistently scoring in the markets, or as it was called when we were in grad school, and I actually wrote the paper, a multivariate analysis of covariance in the United States equities markets, which nobody wanted, right? So we redid the whole thing. We wrote it around the metaphor or the analogy of baseball. It's a cool way of looking at the markets. It's pattern-based, and all these articles that I've written, for the various magazines over the years, what they do is focus on those patterns. So the patterns that we put together in 97 and 96 and 95, really when we were researching them, that's still the stuff that we trade today. So it's been very resilient. It's been very, very capable. The guys who come to the boot camp, you're looking at one of them here. This is a group from last year, or from the last 5 years, I guess. They're coming down there to learn how to do this. And I think the thing that pulls them into wanting to do it with us is that they, the hardiness of it, the longevity of it, and the way that you can go and select different slots of the day to be the times of day that you're going to be working in the market. Not everybody can be there at the open, not everybody can be there at the close, not everybody can be there in the middle, but there's something you can do in each one of those time frames. The big challenge for everybody is to get around their psychology. If you look around, the whole reason I have this picture here is if you look at those photos and you look at the different attendees at each one of these things, the thing to bear in mind is some of those guys are, let me look at it. We've got an architect, we've got a police officer, we've got a guy who's owns a livery company, we've got a guy who's an attorney, a farmer, a rancher, we've got Rick, who was in the Air Force. We've got a bunch of things, doctors, lawyers, professional people, guys who did tool and die work. I'm just thinking off the top of my head. They all come and they all bring their own psychology to this thing. And your psychology is really the hardest thing to overcome. I could teach anybody how to trade. I can show you exactly what it is that we're doing. I could show exactly how it is that we do it. I can show you the exact results that we expect when we do it. What I can't do just by showing it to you is help you figure out how it fits into how you're going to trade. And that's a big part of so our guys we work with for a year, these boot camp things are pretty small. They're just 20 people at each one. We do it twice a year and we're one-on-one with these people all year long, right? So they always pick up the phone, calling, they're coming back to future boot camps. They don't have to pay to go again. They just go. We've got people who have been to every single one and they keep coming because they say they keep learning something about trading when they go. And they learn something about themselves because they're talking to these other people who trade. They learn, from the way that they get around things. They learn exactly how to sort of shape and maneuver given their own psychology. So there's the room of guys. I know most of you guys are here today. That this is your shout out, right? These are the guys who were at the last one. We did sort of a smaller group for new traders, and then we did all of our alumni were online. Next time around, this was in Miami Beach again at the Cadillac Hotel and Beach Club. We love it there. And this is, we study together, we learn together, we trade together over the course of the day. We go out, we have fun together. It's just a whole lot of fun. And, I think you have to look at how you're going to learn as much as what you're going to learn. So the fact that you've got somebody to talk to in this very lonely business of trading, I think is really, really important. So whatever it is that you're going to do, make sure you've got other people in your cohort group you can talk to about doing the trading, because otherwise it's a very isolating business and it's very, very hard to stay on top of. Those are the books. So Around the Horn and Trade Secrets, those are the two core books. Tricks of the Trade, that's a diary that we kept, back in, it's from 2003, I guess is when that was published. And that thing goes through, and you can't buy it anymore. But what it did was gave our trade logs, but I'm talking about psychology. And we had trade logs that would say things like, got up this morning, didn't really feel on top of my game, traded anyways, probably shouldn't have, here's what happened, versus, the next day, got up, had a good night's rest, didn't go out and have 2 martinis the night before, made sure I was going to be on top of my game. And here's the difference, right? And the things that we learned, that's just 1 quarter's worth. The first boot camp we did, there was a table that was 15 feet long, and Julie brought the actual written journals that we had, and they were stacked, 2 feet high, and the entire length of the table. And the takeaway there is you have to keep track of what you're doing. You have to keep track of how you feel while you're doing it, and you have to be super, super aware of self, right? There's a lot of mindfulness that goes along with being a good trader. And if you want to stay on top of your game, later, now I've just got one of these remarkable things, right, where you can just sort of scribble notes when you have them. But the reality is now, our trades are, our logs are much more mechanical. We know how we feel. I know exactly how I feel at 5:30 in the morning when I have to get up to trade on the West Coast versus when I get up at 8 o'clock in the morning to trade on the East Coast. It's a different feeling, believe me. But what we do to remedy that is, we have our trading business is divided into these sections, right? These blocks that you see on the screen. We've got those NYSE trades that we still do, right? We're still creatures of habit. I like NYSE. I like the fact that stocks have a very different personality, different animal than the NASDAQ. NYSE trades are still much more orderly in my book. They're much more predictable in terms of human behavior. They behave the way that people behave. And, I think that if you look at what we're doing when we divide up our trades, we're really trying to make trading much more like clockwork. So we divide the day up into different sections, and based on the volatility that we're going to expect as the market gets into each one of the time brackets, we've got different things that we're going to put into play in terms of the trades that are going to go live. So that clock is actually hanging on our wall. Every one of our boot camp guys has one of those clocks. Probably pretty much everybody who works with us in our online trading room, in the war room every day. You guys probably bought one of those things, and they're cheap. They're not pretty. They're just an acrylic clock, right? It's not a fine piece of furniture, but it keeps you in tune with where the market is over the course of the day, and it keeps you in tune with what to expect in terms of, are we coming into a high volatility period? Are we coming into a market reversal? Is it just sort of smooth trading? We've had that around for a lot of years. I like it. And what it does is allows us to maximize workflow. So workflow is going to be one of the most important things if you're trying to trade intraday. You need to approach it like a business. So if you can't put your trading together the way that you would put a business together, you've already got a big problem. But in our game, right, in our world, so this might not be your workflow. This works really well for us. This is the thing that Julie and I teach people at the boot camps. It's because we developed it, and this is our psychology at work. This is the thing that works for us. This is the way that we see, okay, well, what's the ideal way that we would structure a day? And once we know what the ideal is, well, we want to get as close to that, right? There's espoused and there's enacted. When you're talking about organizational psychology, your espoused ideal work environment and you're enacted. What are you actually doing? Pre-market, we set up a bunch of program trades. We plan our Apple trade for the open. There's an Apple every single day of the week. There's an Apple trade that we're ready to do. Opening bell, we execute the Apple trade. 5 minutes into the day, we go into trading our 2SD opening gaps. I'm going to show you guys both of those trades here in a second. Then after the first hour, we're setting up bracket trades. We're looking at volatility bands. We trade the Magnificent Seven starting around 11:30 Eastern time. let the market settle in for an hour after that first hour of trading, because I go out and in California, right, I take a much colder walk than I'm taking here. I'm on the beach, you know, in 60-degree weather, usually in Malibu there, or I'm walking around in the mountains, just trying to take a hike, clear out your head, get yourself into a space where when you come back and look at your screen again, you've got a very, very clear head and you know what it is that you're going to do next. You don't have a bunch of baggage from the morning just weighing you down. So when I put together my trading plan, this that you're looking at is the automated portion of it. So for us, you know, you can see behind me here, I'm running Realtek. So Realtek, I've been on Realtek for the whole go, right? 30 years I've been a Realtek guy. I used to be the Realtek girl. I used to go around and, you know, show institutional guys how to use the platform. That was a long time ago. But it allows me to automate what you're seeing here. So you're looking at, in this case, this Advanced Auto Parts, right? So Advanced Auto Parts was on the trading plan this particular day. We see that it's got a short, and we see what the entry price is, right? 69.76. We see that our stop is 70.15. We see our target 68.78. The ratio on the trade, whatever, you know, it just tells you how much you're looking at in terms of a potential gain to a potential loss. 50% to target 69.27. So why is that all there? Every bit of that information is there because that's automated. You can just take that, port the spreadsheet in, and tell it, you know what, over the course of the session, here's what I want you to do. If the last price is greater than 69.76 by whatever factor we want to make the greater than, right? I want it to be coming from the proper direction. I want price to be coming from above if it gets me short. Then sell short, stop limit, 69.76 stop, maybe 69.66 limit, right? So I'm gonna give it 10 cents of slippage. I'm gonna build into the trade. If I get to the 70.15 stop, get me out. If I get 50% of the distance to the target, 69.27, move my stop to break even. If I get 10 cents to the target, move my stop to the 50% level. And if I get to the target, get me out of the trade. That's all stuff you can automate. It sounds like, you know, a lot of people want to babysit this stuff. This goes back to your psychology. Can you walk away when you've got 4 positions on? This particular day, you've got 4 positions running, right? And all you really need is this gouge sheet and have the trading software pull it in, whether it's TradeStation or Thinkorswim or whatever. You know, there's ways, everything has an API, and there's always a way to automate everything. And to our way of thinking, this is the stuff that we don't want to have to sit there and sit in front of all day. We know how it performs. We've got spreadsheets that go through and show us exactly every day. So at the end of this thing, I'll give you guys there's no offer to buy anything, but you can come in and do a free visit with us, an open house, see every single thing that we do. You can also go and download. This is what I mean when I say we keep our journals now in spreadsheets and everything. You can go and download the results all the way back to 2006. You can download every single trade that's set up. You can download the entire spreadsheet of what triggered, what was the entry, and it's all objective. There's no maximum favorable excursion. You got in at the entry, you either got out at the stop, you got out at the target, or you got out at one of those money management rules, right? So here was the day, you know, that day there, AAP, KMX, RBTY, TJX, those things, you know, hit targets. They generated results for the day. For the month of May, right, I can go through and analyze my data. So when you look at the spreadsheets, when you go download this stuff, you can see exactly how were the patterns distributed, which patterns triggered, what was the overall profitability of each one of the patterns. You can see there the baseball analogy, right? Fastball, infield fly, line drive, 3-2 pitch, backdoor slider, switch hitter, double header, sinker, right? Those things are all just referring to specific chart patterns that I developed. But you can go and you can analyze your performance over the course of the month. You can find out on a $100,000 account, if you're levered up 4 to 1, right? You're a intraday trader, so you automatically, on a PDT account, automatically 4 to 1. Are you using the leverage? Well, if you use the leverage, right, you're up about 10 grand for the month. If you decide you don't want to lever up that high, if you're 1 to 1, you're up $2,000. You know, and everything is there, all the data's there. That's all the journaling that we need right now. When we get into the trading, the first hour of the day, right? Think back to the timeline now. Now you've got those trades are just handling themselves automatically. You're good to go. You don't need to sit there and babysit, right? Again, it's I use the analogy all the time. It's, if I'm going to interject myself into every single one of these trades, really the only value in that trading plan is it's all set and ready to go. If I'm going to put myself in the middle of it, that's like if my son Connor, who's now 16, decided that the best idea to do on his first date would be to bring Dr. and Dr. Manz with him to introduce them to his new girlfriend, right? The only thing we're going to do by involving ourselves in it is screw the whole thing up for him. And the only thing you're going to do on an automated trade is put yourself in the position to start second guessing things. What we want to be able to work on is we want to focus on the trades that we have that we know exactly how we're going to go and approach on a discretionary basis. So this discretionary trading stuff, it's also pre-planned. So here you're looking at Apple, right? An Apple a day. This is from the 4th of June, and you can see that sketchy data at the beginning there, that's pre-market data. And what I like to do is line it up with the prior session. So I go through the prior session, I start looking for, is there a similarity in where I'm seeing support and resistance in today's pre-market vis-a-vis what happened yesterday in sort of the latter part of the session. And then I like to see is there an inflection that is the result of heavy buying in the pre-market that's maybe going to result in market makers and options market makers and everybody having to take in stock on the opening bell on a retest of that just to cover themselves up, right? Just to stay neutral on their position. So when we have all these areas lined up, then what I do is we go through with the guys in the first hour of the war room, and we say, all right, here's our potential inflection entries. These are the places that we're looking to go long if the stock opens where we think it's going to open and if it makes the inflection that we think it's going to make. So you can see there in this case, the 193.09 level was the one that actually picked us up. But all of these are viable places to have an entry. That blue line up there, that is our target. And that target's based on that volume spike that we saw before the opening bell. That thing had a threshold and it reversed. And what I want to make sure of is that, whatever resistance was there, it's probably from some previous session. It's probably it could be from days ago, it could be weeks, months, right? It could be anything. I just want to get out there. So now I've got a 193.29 entry, a 194.39 exit. And what I do is I bracket that order up, I release it at the open, it's gone, it goes. So at the boot camp, we were just, we were talking with the guys about this, and that's very hard for people because they want to see, can they capture more? Is there a way to capitalize on, additional excursions? And what I say about workflow is I just want always, if you see us at home, you guys have seen our broadcasts and things, and I do some intraday live sort of injections on programs, right? And if you see me sitting there, I'm sitting with a big wall of screens behind me, and everybody says, how do you watch all that stuff at once? I don't. What I'm doing is I sweep these things from one place to the other. So once that Apple trade's on, it's off my radar. I'm going to go and move it somewhere else, and I'm going to focus on that bracket is out there. It knows to get out at that overhead, and it knows that I've got to stop. In this case, stop was down like 192.82 below the lowest entry, and all I care about is that it executes perfectly in my absence. If price comes down and it misses me by a penny, right? This is the big thing that some of these guys talk about. They'll set their entry orders a little bit too tight. They're focused on finding the exact bottoms of those bars. It becomes an obsession sometimes. So get a little looser with it, get a little bit more room. But if it misses me, if it doesn't take me in, that's all right. At 9:30, 9:40, really, it's going to go and cancel those orders. It's a time-based cancellation. Just says we didn't get filled. Let's just avoid getting into the trade. Right? We know where the stop is. We know where the targets are. Here's another one. This is from the 6th, right? So this is from yesterday. Again, same thinking. You go through, you identify where was the prior support, how's that line up with today's support. You're doing an analysis of volume, like all this stuff on the right side of the chart is that's a hierarchical cluster analysis that the guys know how to apply, guys know how to interpret. That's important data in what we're doing. You don't absolutely have to have it. You can also use volume profile or volume by price, the way that A lot of other platforms put it in there. But really what it's doing is it's saying, look, is there confirmation in what's happening in the pre-market with what, with what we were interpreting from the prior session? Is that inflection going to be where we think it is? And if it is, right, we know our target is going to be based on that overhead resistance. We're going to look at yesterday's data. We're going to look at today's pre-market data. Where did price inflect? Right? Where did this thing ram into a spot that it turned around from? And then, once that's there and we know where our stop is, the stop on this one's always super tight. So, your stop is going to be below the lowest low of that swing move, of that support. And if it doesn't go to the target in the morning, trust me, you don't want it. So if it gets you in, then in some cases, like this one was a very tight stop because everything was bunched up right on top of that level. Most cases the stop will be more like the last one we looked at, be 30, 40 cents or something. But that if it gets down there and it gets through this stuff, it's probably something you don't want to be a part of. So 9:30 rolls around, that baby's live, it's swept aside. We know what it's going to do. We've given it different threshold levels to work from, or we've given it one in this case to work from. But most days there's probably 2 or 3 places that we would let it go live. Once it's gone, once that thing's running, there's no value in me poking my head in the door to see what's going on. Just let the trade take care of itself. We move on to opening gaps. We've got an opening gap strategy that really puts probability on our side. Something gaps down, something gaps up, you're out 2 standard deviations, and there's some magic that goes on. So this is 2 standard deviations of volatility is what we're looking at. You can use true range as a proxy for volatility. You can use the implied volatility of the front month contract on each individual symbol to figure out the volatility you're looking at. But one way or another, you're assuming that you're looking at normally distributed data, a bell-shaped curve. It's very important. What I can tell you from years and years of research and years of reading other people's research, volatility is normally distributed. If you're using true range, you're assuming true range is not average true range, right? True range. True range is a proxy for volatility. My data says true range is a very good proxy because true range lets you look at what you're actually interested in, which is range on a given trading day plus gaps. So it gives you a really good indication of how volatile something is and where that volatility is compared to the average volatility. Then you're also looking at volatility as mean reverting. And what's mean reversion? Pretty simple, right? When you look at that bell-shaped curve, that data right in the middle of the bell-shaped curve, that's the mean, that's the average. So you got a bunch of data points, you got a bunch of volatility data. Right there in the middle, that's the average. That's where most of the volatility is going to happen. If you go out 1 standard deviation, I'll show you the calculation for standard deviation in a second here. It's a no-brainer. 1 standard deviation out, you've accounted for 68% of the volatility that you expect to see before you see a mean reversion. Go out 2 standard deviations, now you're out, you've got 95% of the volatility is accounted for. You're in the 95% confidence interval of that mean. What that tells you is you're expecting, you don't know how far back it's going to go, but you're expecting those bands on the outside there to start moving back in towards the mean at some point before the thing, before the distribution would shift and before price would start moving in the other direction again. You're expecting the price is going to sort of come back in. Doesn't mean it's going to come back to the average, doesn't mean it's going to close the gap, because once you've moved back to 1 standard deviation, now you've only got 68% left, right, of the probability distribution. So you have to think of this in terms of, I've got a 95% probability that something is going to happen in terms of a reversion. But once it starts happening, I have to have a strategy in place to get me out of the trade that I get into. So here's just a sample of how you would set up the calculation. You can do this in Excel. You can do this. You can come watch us, in the trading room, and we've got things that automatically go and scrub the data. But it goes and it takes 10 days worth of true range data, and it plugs it into this formula here where you're taking for X1 through 10. So for days 1 through 10, you subtract the average, you sum those all up, you square it, then the square just gets rid of a negative number if it's in there, and then you divide by n minus 1. N is the number of days you're looking at, 10. So 10 minus 1 is 9. 9 are your degrees of freedom. And don't worry about that if you're not a statistician. Just trust me. This is the way the statistic works. This is how you get one standard deviation. Take the square root of that. Square root just gets rid of that square that you put into the equation. And one standard deviation in this case, right, is going to be 49 cents. So 49 cents in the sample data, 1 SD. 2 SD is going to be 98 cents. And multiply that by 2. And then if you add it to the mean, so 98 cents plus $1.25, that's how far the stock would have to gap in order to be 2 standard deviations out in terms of volatility. So take a look at this one here. This is say these are 5-minute bars. So tick, 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 tick. You're counting up into the close of the prior session. Boom. Today the market opens, gaps lower. I call this a 1-2-3 setup. It could be 1-2-3, 1-2-3-4. Between 9:30 and 10 a.m., I'm giving this room to come in. And whatever we're doing, whether it's long or short, we're always following, in the case of a long, we're following the lows up. In the case of a short, we're following the highs down. When we get to the deepest bar, so the lowest high in this pullback, what I'm looking to do is I want to get long above that high, and I want to target something that happened earlier in the trading. So in this case, I'm targeting the open of the first bar. I could be targeting an open, a close. I could be targeting something that has a lot of volume by price. Something important that happened in the first bar is where I'm going to go and I'm going to put together the filter for, is this a trade I want to take? Is there enough room between that threshold level and the target versus that threshold level and the stop? Is the ratio right side up? Is there enough room for profitability for me to get into that position? And what you get is, like on yesterday, this is the list, right? Big list. And remember, 95% confidence interval of the mean. We're taking into account a lot of data when we're scrubbing this list to get it down to this point. But when you take your trial, you can go back and you can look at all the data for the last year, right? You can go back and look at every one of these and run it through a simulator, see what it's telling you. Here was the first one that we actually took yesterday, 5 below. So you can see what we're doing. That orange line there, that's the first high. We follow it all the way down till we get to the deepest bar in that sort of pullback looking thing, that 1-2-3 setup. What we're going to do is set our entry then 110.75. This is Julie and I, and we're going to set the trade up so that we can get long 110.75. 111.88 is the target based on what happened in the first bar of trading. We've got a stop loss set at 109.80, right? We've got the thing bracketed up. It's a bracket order, so it's just out there. It's live. It's going, and once it goes and triggers through 110.75, you're in the position, and now you don't really need to be babysitting this thing, right? If you just have one, you can go and start saying, what are my expansion ratios, all that kind of stuff. But right here, you see that big volume by price node out there. That is the cluster analysis telling us that was one of the most important pieces of data that we saw. That particular volume by price threshold there is super important. The blank spaces just mean that was not important volume in terms of what happened next. That level represents our stop. Then if you hit the target and you are able to babysit it, which yesterday we were not, and you'll see why in a second, you can go and look for the expansions, look for, where would I move the trade? You can just chart trade, drag your exit order up so that you're not getting out at the absolute threshold. Maybe you take a portion off, you move the rest of it up, and you're following. I use fib lines. People are using GAN ratios. I use 382, 50, and 618, or 1.38 to 1.60, 1.50, and 1.618. So those are the only ratios that I'm interested in. I know a bunch of people are interested in other things. That's great. But for me, those are the ones that work. Those are the ones that fit my psychology. 150 is a really, really solid place to look for an expansion. Here's Smart Sheet. This was another one on that list you just looked at. 1, 2, 3, pullback. 44.81 was the entry. 44 is the target. 45.22 was the stop on this. So, when you're figuring out, is this going to be a logical trade for you to be in? It's pretty easy. Just look at the lines, right? As long as my stop range isn't wider than my target, it's going to be on my list. And over the course then of the session, what we see, let me just show you the rest of these here if I can get to them. Yes. There we go. LIVN, right? 1, 2, 3, sets up, goes to the target. Next one on the list was ABM. That was an American Depository Receipt. This one's actually called a trapdoor setup. There's a different kind of a setup. We've got various ways of getting in. So there's 3 ways to get into these and 4 ways to get out. If you join us in our war room every day, you'll see what we're talking about. But they don't have to be that 1, 2, 3. They can also be a second bar entry on a low or a second bar entry, going through a high. But ABM triggers is another big move. So you got this thing all set up and you're ready to go. You're doing fib expansions. You know where your targets are. Sienna went straight down to a target. Halo, right? This one goes, trades higher, gets into that pullback. And if you're looking at it when it makes that 1, 2, 3, 4, 5, 6 kind of a high, as it gets into that lowest or that highest low, you know exactly what to do. You set up the trade, and then based on what you see out on the right side over there, right, those big green bars, that's how I set my target. So even though it doesn't come all the way back down, even to where it opened, get back into yesterday's close, doesn't get into where it opened, we had targets in place. We worked them out. We have plenty of time to talk about this, right, with the guys in the room. We're talking it through. We're saying this is where we're going to put the target on this. Here's why we're going to put the target there. You can go and make sure that this intraday trading stuff is not chaos, right? So that you have a way of just having a relaxed morning. You're just in there and you're doing your thing. You're doing what you know how to do. You're setting them up. Here's Lulu, all right? So Lululemon goes, same thing. Big first bar, gap higher, comes crashing down. Everybody knows, everybody in the room knows that's going to be a trap door. Everybody who's been to boot camp, you better know it's a trap door. And if you don't, you better go and start reviewing your boot camp materials. There's a 650-page manual that goes with that thing, 20 hours of online trading, and 4 days live in Miami. So you've had plenty over the last couple months of information thrown at you. If you forgot why you're supposed to be doing this, you guys who were just there, start flipping and looking for for the setup and figuring out exactly why it is you're supposed to do things, how you do them, how you set up the bracket orders. Here was Monster Beverage, another one. Bam, right? Gets you the setup, gets you into the position, and goes straight to the target, and then keeps going, right? So here's the psychology. The bad thing about this is these coulda, woulda, shoulda thoughts that people have. Because if you're just focused on this one, you've now put yourself in the position of, oh my God, look at this. I got out and the thing, it went another dollar without me. Oh, Jesus, right? And then how many times that happened to you? You're sitting in front of the screen and you're just locked up because you didn't get what you could have had. What I say is you got what you planned, right? Plan the trade, trade the plan. If you use that as your criteria of success instead of, well, how much money did I make on this? How much money did I make on that? The money's going to come. If you've got a sound strategy, if you know what you're doing and you know why you're doing it and you know what you're how you're supposed to execute and what the parameters are around what you're supposed to execute, your measure of success should be, did I do what I said I was going to do? People who do that, in my experience, they succeed. People who focus every single day on the nickels and dimes and did I get the maximum profit? Did I get everything that I could have out of the trade? Those are the people who struggle with this stuff because Americans in particular are wired for winning is good, losing is bad, and it's all about the next. It's got to be a win. It's got to be a win. So what they do is they'll take smaller and smaller trades. They'll take smaller and smaller chunks of change out of the market, and then rather than adjusting the target to get a wider swing, what I see them doing is adjusting the stop so there's a wider loss because losing feels bad. Well, maybe I didn't see this. I'm gonna give it a little bit more room to breathe. I'm gonna give this. I'm not gonna choke up on this so much. I'm gonna pull this back and I'm gonna give myself some room. And before you know it, what you see happening is these guys take big losses, small gains, they're upside down, and then they feel horrible about their trading. And it takes a long time to undo the psychology sort of that evolved around it. So just remember that. And, Semtech, here's another one. I don't want to run long on time and not be able to take questions. TTC, that was another one. VSTO, Vista Outdoor. Here's one where, you had a first entry on a trapdoor, you had a second entry, possibly on the pullback to those highs, but coulda, woulda, shoulda. Did you take a second entry? We didn't, because at 10 o'clock we shut these off. So it's not that I missed an entry opportunity. It's I followed my discipline because I know that at 10 o'clock, the distribution starts to shift. Let me just tell you real quickly what that means, just in case you're not a statistical person. When you start feeding new data into that model, that 2SD that you were looking at in terms of volatility, that starts to change, because now you got all of today's data that's hitting this thing, coming into it, feeding into it. If you really wanted to know, am I 2SD out, at some point you have to draw the line and say, now I have to consider what happened today, make that part of that 10-day look back period, recalculate the whole thing, right? Go through what's 2 standard deviations, what would it have to be at right now. That's sort of what Bollinger Bands are my envelopes, right? My volatility envelopes are a little bit different. I'm looking at 2SD of volatility rather than 2SD of closing price. 2SD is 2SD. What you're looking for is it in the 95% confidence interval of the mean? Nobody invented this stuff. This is old basic statistical analysis, right? Stats 101 is where you learn about the probability distribution. And that's how we put ourselves then in front of, right, the opportunity every single day to get profitable. So what I want you to do is, if you're interested in what we're doing, if you join us from today's seminar, whether you're watching the recording or you're watching it live, I heard Sherry say there's going to be a bunch of recordings that people aren't going to see until later. You can do this traderinsight.com/trade. And when you sign up for it, we'll give you a 4-week morning mentoring trial. And what I would ask is that if you're in there, just ask questions. I don't want a bunch of people in there silent. I like the interaction, right? What I love about boot camp is talking to these people. You can ask anybody who's been to one of the boot camp, people say, can I talk to one of your clients? You can talk to all my clients. You can talk to everybody who's ever been. What that experience is very much like any other experience. If you have a question for me, pick up the phone and call me. If you have a question while we're in the room live in the morning, ask the question. If you're confused, don't stay confused. That's the whole purpose of doing this. That's why you're online with 2 college professors. These are people who enjoy answering questions from students, and we just like to know where everybody's head is at and like to know what everybody's thinking. So if I can figure out how to use the question box here, I'm hoping that this time I left plenty of time for questions.
You see the little box with the arrow pointing to the left? You just pop it out. And then usually what I'll do is go to the received column and click it so the arrow points up, so you have most recent at the top.
All right. So I'm not a GoToWebinar guy.
It's okay. Can I read it for you?
Yeah, please.
So Ron would like to know, what's the minimum amount of money I should have in my account to trade with you?
So it's what we encourage people to do. Even the guys who come to these guys who came to the training, is to start with sort of the lowest PDT account that you can have, which is $25,000. We tell people at least have $30,000. You'll be rotating through these positions. These positions don't tie up a bunch of capital. They're on conditional orders, they're on bracket orders, and we try to teach everybody not to have those. We want the orders to go live based on a condition. So that's part number 1. Number 2 is, what I want people to do is say, all right, a PDT account, the minimum requirement for a pattern day trading account, $25,000. I definitely don't want the minimum, because if I make one trade and pay the commission and break even, I'm out, right? They're gonna tell me I need more money in the account. So I say $30,000, because that gives then $120,000 worth of money that you can use to trade during the day. And at the same time, you've got to learn how to manage darn risk. Because what people don't, people come to me and they're like, oh, I'm going to put $1 million into a trading account, or I'm going to put $500,000 into the trading account. Oh, $1 million. So you're planning on trading $4 million every single day of the week? That's how much money you're going to put to, well, no, I would never do that. Well, don't put more in than you're going to use to begin with, number one. And number two, don't put it in at some expanded level so that you feel like I've got to trade 1,000 shares in order to make this worthwhile. What makes it worthwhile is learn how to do it. Trade 1 share, trade 100 shares, trade 500 shares, whatever it is you're comfortable trading in terms of the risk, because the money doesn't care the market rather, doesn't care how much you'd like to make or what you're willing to lose. Right? The market's just going to move based on this price action, based on these zones that we identify. And what you want to do is say, can I get good at spotting these? Can I get good at the execution? And if yes, then I'll put more money into my account and then I'll raise the share size. But at first I would say start small, and for God's sake, if you've got questions, you call us or you text me, my 310-804-2248. If you've got questions, you can text me right now. But and I always answer. But don't put yourself in the position of I'm going to go learn something and I'm going all in while I learn it. So set yourself up for success.
Perfect. And then IQ is asking, now this was back during the presentation, what are the black, blue, and red lines
So those are
that were on your chart?
Floor trader pivot lines. So those are, nothing that I do really has anything proprietary around it. So the calculations for the 2 SD gaps are something that we developed, but it's something that we share with everybody. So you can see, I think I did the whole 2 SD gap thing for traders exclusive ones. It's probably in the archives somewhere, or go through the whole development of the thing. The red line is the central pivot. So that's just the high plus the low plus the close of yesterday divided by 3. And that goes back to, you guys are all too young to remember it, but when we started, you didn't really have a lot of charting software out there. And floor traders used that central pivot, the red number, as a fulcrum, as the value line sort of for the day. It's where you expected price to be over the course of the session. So it's based on yesterday's daily data. And then the other lines are just derivations of that line. So what happens is those just expand out based on yesterday's high, 2 times the high on the pivot today. They're just numbers that you can just look up floor trader pivots and you'll see the calculations. They're pretty simple. And as you move from the central pivot to that first resistance line, the assumption is if you get to R1, you're going to start moving back towards the central pivot, that you're going to oscillate between those two. If you break R1 and you start moving higher, then as you're moving towards second resistance, the way people who traditionally trade them would look at this is, well, now that first resistance is pretty much going to be my central pivot. That's where I'm expecting now that the volatility or the price is going to start oscillating. They're a really useful tool because there's a lot of programs that trade around them. There's a lot of traders who still look at that stuff. And anything that draws program money and anything that draws other people's eyes to it, that's all stuff that's gonna give you the opportunity to profit from it.
All right, we got one more. Do you trade options with this strategy?
So I personally don't trade options. I trade futures, I trade stocks. We have a lot of people who trade options with these. It's primarily based on the around the horn strategy. So the options, here's the thing about options. When you're trading options and you're looking at intraday trading is based on, you're trying to capitalize on volatility. So you're trying to find manageable opportunities in terms of the volatility. And what happens to options is, as volatility increases, it becomes more expensive. So volatility becomes expensive as it increases, right? That's just how options work. That makes it hard intraday to go and do things like, scalp. We do the Magnificent Seven stuff pretty much over the course of the entire day. And it's hard, it's just hard to get in and out. The spreads are bigger, the price is wrong on a lot of stuff. On the around the horn trades, we've got a lot of people who are using those in terms of longer term positions. So you would take the intraday trade, the pattern's the pattern, right? Everything in around the horn is a cyclical pattern. They're all market cycle based. And if you look at the intraday trade, what you're looking to do is capitalize on, okay, here's where the setup was. This is where the most likely inflection point is going to be for the trading day. This is where the most likely violation of a price level is going to lead to a big move in the other direction. That's going to be my stop. That's how the trade's set up. Over the longer term, those trades are still market cycle trades. If you look at a markup accumulation, markup distribution range, markdown, all that stuff is what the theory here is based on. So what the guys will do is take options positions when the thing triggers. So when that price level is hit, when the threshold level is met, then they'll set up an option around it. Usually it's bracketed out about $5. And that's what you're looking for in terms of, the next week, 2 weeks, 3 weeks. And then you can also trade the option into it.
Excellent. Hey guys, do you have any other questions for Adrian? Signs off. He's got about 5 minutes left. I did post the link in the chat. I think Timothy just said, thank you, Adrian. Good presentation and sharing of knowledge.
Great. If you guys have questions afterwards, sometimes it's people who watch these things in the replays and stuff, or in the
we get a lot of replays too.
Yeah, it's a disadvantage. You feel like, well, don't feel disadvantaged. Just go ahead. So it's Adrian, Adrian, at traderinsight.com, TRADERINSIGHT, like I had an insight.com. And, just send me an email. I'm happy to answer questions.
I posted that in the chat as well. All right. Well, I don't think you'll mind to have 4 extra minutes for the beach, right?
4 extra minutes for the beach. Here's one. Yeah. Do you have a few services? What's the best order to do your program? I would say just, you can come in and you're going to look at everything. If you do that trial, you can look at everything. And then, like I said before, you want to look at what fits your psychology the best. So, what is it that's not a big, hurdle for you? You should never do it if it's uncomfortable. If it's uncomfortable, simulate it for a while. See if it gets to be comfortable. And then if something just jumps out at you as, yeah, this is something I can, this is easy. This is an easy fit for me. This is great. You'll be able to see all of it. And then if you have questions about how to, how to wrap it around your psychology, or how to make it work for you, then you can talk to us, or you can talk to any one of, we've probably got 250 or 300 alumni who, all of them are always happy to get on the phone with somebody new and sort of go through their experience. If you tell me what it is about it that you find challenging, I guarantee you I'll be able to hook you up with somebody who felt challenged by it a couple of years ago and is doing it for a living now. And then you can call them and just see, did they make an accommodation that's something that's feels reasonable for you? You don't want to go changing your work schedule. You don't want to go, not be able to drop your kid off at school because, oh my God, I've got this thing I'm doing, and I have to be there for it. Keep time for your life, keep time for the things you enjoy, and then figure out, can I make this work for me? Yeah. Anybody else?
That's great advice. I also like the part where you said, don't stay confused.
Absolutely. Absolutely.
Confused people just go away, right? But don't stay confused. And I have a few people that I work with. They're like, if it takes you more than 5 minutes to work it out, talk to me.
Right. Because it gets, otherwise it gets frustrating, and frustrating is bad, right? Frustrating is another one of those things that leaves you feeling just like you can't get over a hill, right? You just
so
can't.
Unsettled. Yep. I get it. Yep. All right. Well, I appreciate your time. I appreciate you breaking away from the beach and the beautiful sunshine to come and share with us. We appreciate it a lot.
All right, Sherry. Thank you.
Many thanks to our sponsors for the June Live Trader Showcase, Market Taker Mentoring, TechniTrader, and Money Mentor. Please go check them out at markettaker.com, technitrader.com, and moneymentor.com. Thank you again.